I'm trying to fix the problem I was having earlier with the recorder for some reason deciding to quit in midstream. I hope it's going to stop doing it.
I have a new video
It
that
was stopping it around this particular period of time. It looks like it may have stopped now. I'm now going to try to do another video. Hopefully this time it will work.
Liquidations coming. And what's going on is this. The real situation regarding the housing market has not even yet really come to everyone's attention at this time. For example, I'm now going to show a graphic that is part of the video right here, which is showing, hopefully, that the market cap rate that we've been seeing since 2014 regarding what they call net yearly income regarding real estate investment. And as you can see here, in 2014, it was only providing around 5.4% return on investment, which would mean that on the average investment, if you spent $100,000 on a property, you would only get about $5,400 worth of yearly income as a proportion of that. However, as you can see in this chart, that indicator has been declining steadily since then, especially due to the issues regarding COVID. And so now, if you notice the video right here, it is indicating only 4.4% as a net income cap rate, which means you should only get $4,400 for every $100,000 of investment. Now, say, for example, you were to do that kind of comparison for, say, this building, which was originally sold for $5 million, that would mean that you should only get in and around 4.4% of that as a possible net income. However, that's only a possible net income, because what is going on is that, of course, this is the industry standard regarding return on investment, but not necessarily individual behavior and also the actual market itself. And so what's going to happen is I'm now going to demonstrate that if you do a comparison regarding the mortgage rates versus the market capacity, here's where things get really scary. What's going on now is the current mortgage rate, as this report is indicating from a number of sources, is now at around 6%. However, the net income rate, which basically should be the average of what you should expect, is only going to be 4.4%. That actually means you have a net operating loss for all money that is ever spent on any real estate property at this time. And that would mean that, in effect, that makes this situation untenable. And as this video demonstrated, sorry, I'm trying to get that right point. There we go. Debt cost, if it's greater than profit yield, then you're going to have a complete divestiture of that market. In other words, no one wants to be a part of a market that the debt costs will actually supersede any profit yield. And so what's really going on now is that this market is really primed for a major market correction. And as a result, there's going to be a major issue regarding rents. Now, here's another bit of information here. Now, this is for what they call mortgage-backed securities. These are the rates of return regarding mortgage-backed securities, which means these are the securities that are bought after a purchase is done, and this is the rate that they're expecting to get regarding those mortgages. Again, it's showing a 5.25% rate as of June 2022. Again, that's going to be above the net income average performance in the market, which is only 4.4%. So we really do have a situation where we have a perfect storm occurring regarding the issues in this market. another bit of information that I noticed in the video was that they were starting to do some breakdown regarding rental markets. And in this case, this is what the current status is regarding how rental markets are behaving. A normal average would be that 95.8% or so would be rents paid and collected on time, no problems. However, in third quarter 2021, it reduced down to about 89.6%. Then in fourth quarter 2021, it was at 88.9%. Now it's at 87.5%. 4%. What that really means is that now, in effect, landlords are seeing an increasing number of people not paying their rent either on time or not paying it at all. And in that situation, now you're starting to get the issue of what they call debt, rental debt collection. And that it brings up another really interesting scenario. The simple fact is, during the original pandemic, there were 3 million evictions that were stopped due to both state and federal moratoriums. Now, of course, we are still in the middle of COVID. COVID has not ended. It's actually, at this point in time, even more severe than any point in time during the pandemic, even with all the tools that we have. The problem is the virus is mutating too damn fast. And because of that, even a Omicron tweaked vaccine that's being discussed right now has not yet even been tested regarding how effective it would be regarding the new variants. It may very likely be that they are ineffective on the current ones, which are BA4 and 5, which are now just starting to become about half of the current new infections in California. Thus, the real issue is that you're going to not only have rent debt increasing, but you're also going to potentially, in reality, get a flood of evictions. Now, what that is going to do, in effect, is it's going to cause a massive devaluation of rental properties, because most rental property market analysis is based on rents collected over the cost of ownership. In other words, if a significant number of people are evicted, it's going to have no choice but to force the rental market to go into lower pricing. Now, of course, this could be prevented by avoiding the evictions and just voluntarily lowering the rates. In some cases, as I pointed out in a previous video, that has already happened. But what's going on now is that, again, this rental market is still in a significant bubble. And this video does a very good job at demonstrating that in many different ways. Now, here's the other factor that people are going to have to bear in mind. And that is, here is a chart that is showing what is called the corporate bond yields. Now, these are true passive investments that give returns to the investors rather than having to do any kind of work to actually achieve any potential investment. Literally, it's hands off and you just sit and collect. Investing into a mortgage or apartments and so on for rents and so on is a completely different story. A lot of work needs to be done. The people who are owning the property are responsible for any maintenance and other issues regarding the property, no matter what. And so in this case, this graph is showing that in June 2022, the rate of corporate bonds has risen to 4.7%. which means it's now 0.3% better than rental investments. Now, again, most of these corporate bonds are rated AAA or the worst AA. Rental investments, I cannot, at this point in time, even consider that there can be any of them that could be rated AAA. No, what's going on now is now you've got an alternative investment that is safer and provides more income than being involved with this kind of a market. This is going to lead into a significant market correction. especially if the Fed continues to increase rates, which again, in July, they already have said they intend on increasing the Fed rate by 0.75%. Now, if that's the case, then the current mortgage rate that I showed earlier and the other rate would also increase by 0.75%. And that would mean that, no doubt about it, if that's the case, if the mortgage rates are now achieve 6.75%, and yet the maximum yield with all things being best done is only going to result in 4.4%, I would say that this market is, in effect, a dead market. And what's really going on is that there are other indicators showing that not only is that occurring, but for example, if it turns out that the evictions are allowed to occur, you will have large sums of rental properties go into foreclosure. That is going to then, of course, kill whatever earnings that was being done in the rental market. Second of all, it will in effect replay exactly what we were going through in 2007 and 2008. It will result in the likelihood of as many as 2 to 3 million properties being dumped onto the market in a market where the market demand is being decreased because of increased cost of debt. Well, if that's the case, well, then you're going to see a major crash. And in this video, it literally is describing the idea that what's going to happen is that as these things become very apparent that they are a no-win scenario, massive liquidations are going to occur. And when they occur, they're going to hit certain areas disproportionately. And in this case, I have a map that was indicating the places where it is very likely to see the worst of the worst. Give me a second. I'm trying to find it for you right now. Here it is. As you can see here, this map is showing the hot spots regarding market corrections. If you notice over in the West Coast, the San Francisco Bay Area is definitely going to be a large area of loss. It will meet the at least the lower to middle ground regarding the highest potential increase of losses regarding real estate value. Why? Because again, we have been in a situation where, especially in the rental market, we still are in a bubble. It has not yet corrected. And I'm just trying to be constructive and inform people that this is indeed a major problem. And if this problem is not adjusted for right now, then you're just prolonging the pain and magnifying the impact. This is the reason why it is critical that we have to maintain eviction moratoriums. We have to maintain rental assistance because we are not out of the woods. COVID is still here. A recession's on the way. There is major news out there saying that job offers are being pulled away, people are being fired, and a lot of other factors. Now, add on to that, believe it or not, the recent Roe v. Wade decision, which is now going to force a lot of the tech companies that decided to implement work from home for temporary workers, but keep them in the general area by moving them to the least expensive housing, which was in Nevada and Arizona and New Mexico and Colorado, and also, of course, Texas. Given that situation, a lot of these tech companies are now being forced to possibly relocate out of those areas and go into others. But they're not going to return to California because they can't. They want those workers to be still contractors and not employees. And so they're never going to be able to bring those people back to California. What's going to happen is those people, as I'm going to point with my pointer, instead of being in this general area or in this area, may be forced to go into Washington State, Oregon, or more likely to go to the Northeast, New York, Massachusetts, Vermont, New Hampshire, Maine, Rhode Island, and Connecticut, where housing costs and other issues are significantly lower there They have at least better potential labor laws there. And especially for the state of Massachusetts, they have significantly regulated things like auto insurance, where as long as you're a really safe driver, you pay very cheaply for auto insurance. When I lived there, I was only paying $700 a year for my auto insurance. And that was very comprehensive insurance, a deductible of no more than $250 regarding personal injury or property. In California, you're talking about $2,500 a year on average for that kind of coverage. Same deal would be for all the others. Why? Because the state of Massachusetts regulates the base rate. Now, of course, they have what they call safe driving points, like we all do, but those safe driving points have a direct impact on your rate. If you your base rate is 15 points, you can reduce that down to 9. If you get down to 9 points through safe driving, you wind up reducing your auto insurance by as much as 30%. They also have surcharges that can go up to 30 points. Then, of course, you're starting to talk about paying 2 to 3 times the base rate. So yeah, it's really an issue of Massachusetts has done a very good job at establishing a good baseline for cost of living. That is a very good one right there. And of course, the other factor is they have a very small, much smaller, more manageable environment compared to California. And finally, of course, another factor for California, we are in a water disaster right now. And so I can only imagine that if California were to succeed in even recovering maybe 5% of the people that were relocated out, the water disaster here would get easily 10% worse. So I would say it's very unlikely that California is ever going to be what they call normal again. And I'm not going to be surprised. I'm still keeping an eye out on the Zumper website regarding any updates regarding rent. I am not going to be surprised if we're going to start continuing seeing a downturn regarding rent in the city of Mountain View because of so many big impact things going on. And it's just inevitable that we are right in the beginning of another disaster. This would be the kind of timing that I would say Mike Burry and all those little minority of short investors regarding the real estate market were seeing this in effect in 2005, 2006. They knew it was coming and they were prepared. Now we are in a time where we're now getting more real-time data, and now I think everybody here should get a grip and understand that we better get adjusted to a new reality or it's going to hurt very much. Now, I understand that this is going to be contrary to a lot of other people's point of view, but I'm now starting to show that even resources like Redfin have gotten a lot of news articles indicating that this situation is happening, and that means that I now have 2 different independent reliable resources to point out that this is what's going to happen. And if we don't get ourselves prepared for it and start taking the steps necessary, we are going to be in a lot of trouble. I strongly believe that under these circumstances, it should be common sense that eviction moratoriums should be held in effect indefinitely until the COVID situation is over, and rental assistance at the same time should be too. The idea is that when COVID is truly over, then we will probably not be in any position of a recession, because at that point in time, things will be truly restabilized, and probably the situation regarding inflation will have been corrected, because guess what? When you're in a recession, if there's at the same time high inflation, then you're in even a worse case scenario than ever. You're talking about the concept of stagflation. And the only way we were able to get out of stagflation was to raise interest rates to the point where I believe the Fed rate was actually above 10%. And I don't think we really want to see that. So the only way we're going to be able to do that is by taking steps now to mitigate losses as much as we can. But unfortunately, when it comes to real estate and so on, that means, in a certain sense, starting to socialize housing. And if we start socializing housing, then of course that would stabilize the housing market, at least for the time being. But of course, you know that because the free market either grows or dies, we will probably wind up being in a situation where socialized housing may never be dismantled in this country. Now, granted, the private industry is going to go completely crazy about the idea that the public sector is actually, in effect, going to regulate them as much. But again, look at the alternative. What they're arguing is that they want their investors to be protected and no other investors to be protected. No, you can't have that kind of special rights. It's either going to be every market or no market in that scenario. You cannot, and in this case, of course, if the market in this scenario is demand being completely destroyed because people can't have a place to live, well, then all the other markets are going to fall apart no matter what anyway. So in that regard, in a certain sense, if we were to do eviction moratoriums and socialized housing, at least those people can potentially see their properties be at least maintained and not collapse. But it looks to me like the collapse is already here. It's just not being felt yet. Thank you for your time.